Millions of people in the UK are about to wake up to a reality where their bank access, car costs, side income, rent, and even social media accounts are controlled by a wave of new laws. Some will lose money without understanding why. Others will see accounts restricted, taxed harder, or quietly flagged in the background. But buried inside these rules are perfectly legal escape routes that smart people are already using. If you know them early, you can protect your money, freedom, and lifestyle, while everyone else is still trying to figure out what just changed. Starting right now. Number 1. Biggest overhaul of legal migration system. The immigration rules changes announced in November 2025 mark the most significant shift in the UK's migration framework in over 50 years. Under the new rules, migrants seeking permanent settlement will face a longer qualifying period, potentially up to 10 years, unless they meet stringent contribution thresholds. Migrants arriving on small boats or irregular routes may need to wait 2 decades or more for settlement rights. These changes matter because they affect millions of people who live, work, or study in the UK, whether as skilled workers, students, or family members. The government's goal is to prioritise those who contribute to the economy, but the effect is a tougher system with fewer automatic rights. For anyone interacting with the system, employers sponsoring workers, migrants planning their future, or businesses relying on migrant labour, this law introduces new planning demands. To adapt, individuals should review and document their contributions, for example, duration of employment, salary, tax records, and community involvement. Employers must ensure sponsorship compliance, track worker tenure, and explore alternative immigration routes. Those already in the UK anticipating settlement should synchronise their applications before deadlines and revisit their visa status. If unsure, seek professional advice early, because failure to meet the new thresholds could mean a much longer wait for settlement, or missing out entirely. Number 2. Digital ID requirement for banking and government services. The UK is moving toward a nationwide digital ID system that will become mandatory for major financial and government-linked actions, including opening bank accounts, high-value transfers, loan approvals, tax-related transactions, and benefits access. The law is designed to combat fraud, money laundering, and identity theft by replacing traditional paperwork with a single verified digital identity. Millions of people will feel the impact because banks, payment providers, and online government services are required to phase out older verification methods throughout 2025 and 2026. Reports indicate that the digital ID database will connect to HMRC, the Home Office, and law enforcement systems to verify identity instantly and flag potential financial irregularities. Critics worry that those without proper documentation or technical understanding may face account restrictions or delays using essential services. The transition is happening gradually, but users will eventually need a verified digital identity to carry out transactions that used to require in-person ID checks. This applies to both UK citizens and foreign residents. People working cash-in-hand jobs, freelancers receiving international payments, or individuals sharing bank accounts with family members could face additional proof requirements. Banks are already notifying selected customers to update their verification details or risk temporary limits on withdrawals and deposits. For people living abroad but maintaining UK accounts, identity authentication through facial recognition or document scans will be compulsory. Older accounts with outdated credentials are more likely to trigger review flags during the rollout. The easiest legal way to avoid being restricted under this law is to verify early instead of waiting for the mandatory deadline. Gather necessary documents such as passports, biometric residence permits, and proof of address. Then activate the digital ID through your bank or the gov.uk verification gateway. Those without passports can apply using driving licenses and certified supporting documents. Households that share financial access should ensure each adult has an individual verified identity to prevent frozen transactions. Businesses and freelancers should update invoicing records to avoid payment delays once banking platforms fully adopt the digital ID system. Number 3. Energy Efficiency Standards for Rental Homes 2025 Reform. Landlords across the UK will soon be required to upgrade rental properties to meet strict minimum energy performance ratings, aiming to reduce carbon emissions and lower energy bills for tenants. Under the new law, every newly rented property must reach EPC rating C or above, and existing tenancies must comply within a phased timeline. Properties that fail inspections could face penalty charges, rent restrictions, or legal notices preventing landlords from listing homes until improvements are made. The government estimates that millions of tenants are living in poorly insulated, high-cost homes, and this reform aims to ensure healthier, more affordable living conditions. The impact of this law extends to both property owners and renters, particularly in older buildings that rely on outdated heating systems and single glazing. Upgrades like wall insulation, double glazing, smart heating controls, and energy-efficient boilers will become essential rather than optional. Many landlords have raised concerns about renovation expenses, yet long-term, the modernisation could increase property value and reduce tenant turnover. Renters, especially families, will benefit from improved warmth, reduced damp, and noticeably lower monthly energy payments once properties meet the new standard. To avoid penalties legally, landlords should begin by obtaining an updated EPC assessment and identifying the least costly upgrades with the highest rating impact. Priority improvements include insulation of walls and lofts, sealing air leaks, and replacing aging boilers with approved energy-efficient units. Local councils are offering grants for some households, and private financing options allow staged upgrades over several years. Tenants can request written energy efficiency plans from landlords, helping both sides stay compliant and reducing the risk of disputes during the transition smoothly. Number 4. Mandatory recycling and waste charging policy for households. A major environmental reform will require every UK household to separate recyclable materials or face new waste disposal charges. Local councils will introduce pay-per-volume and weight-based fees for general non-recyclable rubbish, while recyclable items such as plastics, paper, glass, food waste and metals must be placed in dedicated bins. The law is intended to reduce landfill usage and push communities toward responsible waste management. But it could affect millions of families who are used to single bin disposal. Councils will be authorised to monitor bins, issue warnings, and apply penalties if recyclable waste is repeatedly mixed with general rubbish. Flats, shared homes, and low-income households could feel the biggest impact due to limited storage space and higher disposal volumes. The reform introduces an infrastructure upgrade where councils expand food recycling collections and install new smart bin systems to automatically weigh household rubbish. Families producing more non-recyclable waste will pay a higher monthly waste bill, similar to how energy usage is billed. Households with infants or medical needs that generate additional waste will have designated exemption categories, but supporting documents will likely be required. Public response has been divided, as many support environmental goals, while others see the model as an increased living expense during an already difficult economic period. Supermarkets are also expected to reduce packaging and promote refill stations to support nationwide compliance. To legally avoid extra charges, households must separate waste accurately and reduce non-recyclable output. Simple adjustments like switching to reusable grocery bags, buying larger refill packs, and choosing minimal packaging products will minimize the volume of charged rubbish. Families can compost food scraps to reduce bin weight, and parents can explore reusable alternatives for high-volume disposable goods when practical. Councils will provide free recycling calendars and collection schedules, and households that comply consistently should maintain 0 additional fees under the new policy. Number 5. Stricter road tax rules for high-emission and non-EV cars. The UK is introducing a reformed vehicle excise duty, road tax, structure that will significantly increase annual costs for petrol and diesel cars with higher CO2 output. Even hybrid vehicles will see adjusted rates based on engine size and emission levels rather than fuel type alone. The biggest shift is that electric cars will no longer be fully exempt, and from 2025 onward, most EVs will begin paying road tax, although at a lower rate than combustion cars. Drivers renewing older petrol and diesel vehicles may face the sharpest increases, especially models registered before 2017 that fall into higher emissions brackets. Motorists in London, Birmingham, Bristol, Manchester and Glasgow will also encounter expanded clean air zones, where non-compliant cars must pay daily charges to enter the city centre. This law affects millions of drivers because commuting patterns and car ownership habits have not caught up with the speed of regulatory change. Families that rely on larger vehicles for school runs, tradespeople transporting tools, and rural households with limited public transport options could face higher yearly costs. Used car buyers in the lower income bracket might struggle most, as cheaper second-hand petrol and diesel vehicles will carry the highest emissions-based tax rates. Insurance companies are evaluating risk categories for non-EV cars, meaning some premiums could rise alongside the updated road tax policy. Infrastructure rollout for EVs is improving, but remains uneven across different regions of the UK, creating pressure to transition without full nationwide support. There is a clear legal approach to minimise the impact of this reform. Before renewing a vehicle, motorists should check the updated emissions category online to compare potential annual road tax differences before and after 2025. Switching to a low-emission model, rather than a fully electric one, can offer the best balance of affordability and tax savings during the transition. People who drive older vehicles should consider selling before the policy takes full effect to avoid higher resale depreciation. And commuters living near restricted zones can save hundreds per year by registering for council discount schemes where eligible. Number 6. Online safety and social media verification law. The UK is enforcing a new online safety and identity verification law that requires major social media platforms to provide verified identity options for all users and apply stricter monitoring of harmful content. Accounts involved in repeated harassment, financial scams, misinformation, or anonymous abuse can face automatic suspension if identity verification is refused after flagging. Parents will get enhanced controls for children's profiles, and platforms must block underage sign-ups using age estimation technology. Millions of people may feel the shift because platforms will be legally responsible for user activity, rather than just acting as hosts. Influencers, online sellers, and content creators could be affected most, as monetization access may require a verified and transparent identity profile before payouts are released. The law is driven by rising cyberbullying cases, fake account fraud, and AI-generated misinformation spreading across digital platforms. Technology companies will have to track user patterns, flag unusual financial activity on marketplace tools, and label manipulated content, including deepfakes. Anonymous free speech will not disappear, but verified users will receive priority visibility, safety protections, and dispute privileges, making non-verified accounts less powerful over time. Digital marketers and gig economy earners who rely on online sales or paid collaborations will need stronger compliance, because brand partners will prefer verified identities to avoid legal liability. Online hate and anonymous trolling will become much riskier, as authorities can request platform-stored identity data when investigating abusive behavior. To avoid negative consequences legally, users should complete platform verification early by linking government-approved IDs, phone numbers, or banking details. Parents should activate updated family safety dashboards immediately to prevent automatic account blocks when the law is fully operational. Online businesses should review their customer interaction policies, store purchase receipts clearly, and avoid automated responses that may be flagged as spam behavior. Influencers and digital sellers can protect income streams by displaying a verified badge, creating transparent contact details, and updating account bios to ensure algorithmic trust signals remain high under the new safety rules. Number 7. Universal cash reporting and high-value transaction monitoring law. The UK is introducing a financial transparency policy that requires banks, payment apps, and digital wallets to report high-value cash deposits and unusual transfers automatically to HMRC. The focus is on tracking undeclared income, side earnings, and informal business payments that would normally go unnoticed. Cash deposits that appear inconsistent with a person's declared income may trigger account review, and repeat transfers between personal and business accounts could be flagged for investigation. This law will impact millions of people who receive freelance income, marketplace earnings, home-based business revenue, or family remittances directly into bank accounts. Even gifts and shared household funds may require documentation if they exceed reporting thresholds, meaning financial habits that were once normal will now require proof of origin. The rollout includes upgrades to banking algorithms that analyze income patterns, spending behavior, and transaction frequency. Apps used for selling on platforms like Vinted, Facebook Marketplace, eBay, Depop, and TikTok Shop will be connected to banking systems, so earnings automatically contribute to personal income records. People receiving repeated small transfers from friends or relatives could also trigger income-like behavior alerts if the pattern resembles payments for goods or services. The law is not targeting ordinary family help, but bank algorithms cannot determine context without user-provided information. As a result, lack of documentation could slow access to funds, delay withdrawals, or lead to temporary account freezes until clarification is provided. There is a legal way to avoid issues under this policy. Anyone earning online or offline should maintain clear digital records of where money is coming from, including screenshots of orders, invoices, buyer messages, or salary slips. Those receiving family support can describe payments clearly in bank references to prevent misunderstanding. People operating informal businesses should register for simplified tax schemes to protect their accounts. Personal and business finances should be separated by using different bank accounts, ensuring that automatic monitoring does not misinterpret ordinary activity as undeclared income. Number 8. Mandatory workplace pension expansion and auto-enrollment increase. A major employment reform will expand the auto-enrollment pension scheme, requiring more workers and more employers to contribute toward retirement savings. The minimum contribution rate is set to rise gradually, meaning monthly deductions from employee salaries will increase unless they opt out. Young workers aged 18 and above will now be auto-enrolled instead of the previous 22-year threshold, and part-time workers earning lower incomes will be included for the first time. Millions of people will see smaller take-home pay because a higher percentage of wages will go directly into pension savings. Employers who do not comply could face financial penalties and legal action for failing to contribute the required share toward employee pension pots. Self-employed individuals will also be encouraged through a new national framework that automatically connects tax returns with pension-saving options. This policy aims to reduce future retirement poverty, especially for younger workers and people with irregular employment patterns. However, the short-term impact on disposable income will be noticeable for many households already struggling with rising costs. Workers with multiple part-time jobs may be auto-enrolled into multiple schemes, creating complexity when managing pension accounts across different employers. Small businesses will need to adjust payroll systems to track contributions accurately and avoid non-compliance during audits. Workers reaching retirement age soon may also notice changes in how pension withdrawals are taxed, as the government attempts to prevent pension pots from being depleted too quickly. To navigate this law effectively and legally minimize financial pressure, employees should review and consolidate existing pension accounts to avoid losing money to multiple management fees. People with tight monthly budgets can request temporary lower contributions if permitted by their employer, while avoiding full opt-out, which would forfeit employer contributions. Self-employed workers should open a government-approved pension plan linked to income declarations to benefit from tax relief automatically. Small businesses can protect themselves by using payroll software that tracks pension deductions in real time, reducing the risk of costly compliance errors during the rollout period. Number 9. Housing market. Anti-vacancy and second property tax reform. The UK government is launching a housing reform targeting vacant homes and second properties to free up residential supply and reduce pressure on renters. Councils will be allowed to apply a 100 to 300% council tax surcharge on homes left empty for an extended period, and properties used mainly for short-term holiday rentals will face higher tax bans unless registered as fully licensed serviced accommodation. Owners of second homes who spend most of the year living elsewhere could lose previous tax discounts, and proof of continuous occupancy may be required for exemption. The reform is driven by rising homelessness and record rental demand in major cities, where a growing number of houses are purchased purely as investment assets rather than lived in. Landlords with multiple properties will face closer reporting to prevent misclassification of holiday rentals as private residential listings. This law will affect millions of households, particularly people who rely on short-term letting income or inherit family properties they do not fully occupy. Holiday home hotspots such as Cornwall, Devon, London, Edinburgh, and the Lake District will see the most immediate changes, with booking platforms required to verify that listings hold the correct license. New tenants will receive more protections against eviction in properties being switched between rental models, and councils will gain the authority to block further holiday let conversions if a neighbourhood's housing stock becomes imbalanced. Critics argue that higher taxes may lead to rent increases, while supporters believe it will push unused homes back onto the long-term rental market, lowering prices for residents. Investors who fail to register their property type properly could face unexpected backdated tax charges. A legal way to reduce the financial burden is to convert an underused property into a compliant long-term rental, rather than leaving it empty or relying solely on seasonal occupancy. Owners can also apply for renovation exemptions if a property is being repaired, which pauses vacancy surcharges. And joint inheritance owners should document occupancy agreements to prevent penalties. Those running genuine holiday rentals must secure the correct license early and register bookings transparently to avoid multi-year tax reassessments under the strengthened housing law. Number 10. New employment status reform for freelancers, gig workers, and side earners. A major labour reform will redefine how the UK classifies freelancers, gig workers, contractors, and platform-based earners, with the goal of preventing companies from avoiding employee benefits by hiring staff as self-employed. Under the new law, a worker's status will depend on the nature of the work and level of control, rather than the contract label chosen by the employer. If an individual works regular hours for one company, follows schedule instructions, or depends on a single client for the majority of income, they can be reclassified as an employee. Workers in ride-hailing, delivery, online services, cleaning, care sectors, and remote digital roles are likely to experience the biggest shift. Companies that misclassify staff could face penalties, and affected workers may gain rights such as paid leave, sick pay, and pension contributions. The reform affects millions because the UK's earning landscape has changed dramatically, with more people relying on TikTok Shop, Etsy, Fiverr, Uber, Deliveroo, Amazon Flex, and OnlyFans as primary or supplementary income sources. Many workers don't realise that earning from one platform or returning to the same client repeatedly can be seen legally as employment rather than pure freelancing. Once the reform takes effect, platforms will be required to report worker activity patterns to HMRC and the Labour Authority to determine correct status. People who combine full-time jobs with side hustles may also trigger review if their secondary income resembles structured employment rather than casual trading. To legally avoid issues and reduce risk of unexpected tax or employment disputes, individuals should clearly define their working model. Freelancers must show independence through multiple clients, written contracts, and their own pricing control. Platform workers expecting to work full-time hours may benefit from employee status rather than resisting it, since they would receive additional protections and paid benefits. Anyone who prefers to remain self-employed should diversify income streams, maintain independent business branding, and use separate invoices for each client. Companies hiring contractors can minimize penalties by updating agreements to reflect genuine independence and ensuring no single contractor functions like an internal employee under the strengthened employment rules. The UK is entering a phase where laws are reshaping everyday life: banking, driving, renting, working, earning online, and even daily household habits. These regulations are not designed to hurt people, but the reality is that those who don't understand them will face higher costs, account delays, financial restrictions, and lifestyle changes they never prepared for. The good news is that every single one of these laws has a legal, safe, and accessible path for people who stay informed and organised. Verifying digital identity early protects banking access. Separating waste avoids extra monthly charges. Tracking income records prevents account flags. Upgrading property energy efficiency increases value instead of causing penalties. Choosing the right vehicle before 2025 saves hundreds each year. The difference between people who struggle and people who stay ahead will simply come down to who adapts in time. Instead of fearing new regulations, you can use them strategically to protect your savings, secure your lifestyle, and make smarter long-term decisions for yourself and your family. Knowledge is no longer optional. It's a shield. Staying updated means staying in control. If you found this breakdown valuable, hit like, subscribe, and comment "Ready" so we know you're prepared for the new changes coming to the UK. And don't forget, explore our other videos for deeper strategies to save money and protect your future under the 2025 UK laws.